Welcome to PolicyCast. Today, we are joined by Nikita Gulati, a seasoned US tax advisory professional, to discuss pre-immigration planning from a US tax perspective, a critical area for high net worth individuals and globally mobile tax players. If you are considering relocation to the United States, this episode will provide actionable insights to mitigate tax exposure and ensure compliance. Nikita, why is pre-immigration tax planning so critical for individuals moving to the US?
Thanks for the question, Simran. The United States basically imposes tax on worldwide income. That is when once an individual becomes a US tax resident under the substantial presence test or through obtaining a green card. Pre-immigration planning allows taxpayers to optimize timing of income recognition, restructure ownership of foreign entities, and address exposure to complex regimes such as PFIC, which is Passive Foreign Investment Company, and CFC, known as Controlled Foreign Corporation Rules. Hence, without planning, individuals risk double taxation, punitive interest charges, and significant compliance cost. Thus, the US taxes global income, so understanding timing, asset structuring, and compliance obligations can significantly reduce future tax burdens on our taxpayers, and that can help avoid surprises too. Thus, aligning tax strategies with immigration pathways, whether employment-based visas like EB1, EB2, and 3, investor programs like EB5, family-based routes, or newer options such as the Gold Card initiative is actually very essential for achieving tax efficiency and compliance.
This is for our listeners. The Gold Card is designed for high net worth individuals and corporations. Unlike the EB5 Immigrant Investor Program, it does not require job creation. Instead, eligibility is based on making financial contribution to the US government, announced in September 2025 through an executive order. My next question to you, Nikita, what are the key steps someone should take before they become a US tax resident?
Well, I would suggest that one should start by reviewing the global assets and their income streams, followed by considering accelerating income or realizing gains prior to triggering US residency to avoid, of course, the highest US tax rates what we have. It should first again be coupled with restructuring ownership of foreign corporations to mitigate any CFC implications and subpart F income exposure. Next could be review investments for PFIC classifications common in individuals traveling towards settling in the US. They hold foreign mutual funds, and they can even consider divestment or restructuring around that. Last but not the least, it is important to establish cost-based documentation for all assets to support future capital gains reporting.
Thank you for those insights, Nikita. My next question, how do estate and gift tax rules impact pre-immigration planning?
The US has a comprehensive estate and gift tax regime. Non-residents have limited exemptions though, so planning before entry is certainly essential. Strategies include gifting assets before residency and using trust or other vehicles to manage exposure. US estate and gifts tax applies a worldwide assets for residents with a current lifetime exemption of approximately $13.6 million, which is certainly subject to legislative changes. However, for non-residents, they only have $60,000 exemption for US CITES assets. Hence, strategies include gifting assets prior to residency to leverage non-US status, followed by there could be utilization of foreign grantor trust or qualified domestic trust, commonly known as QDOT, for spousal planning. And last but not the least, one should definitely be addressing generation skipping transfer tax exposure for multi-generational wealth transfers.
Are there common pitfalls when individuals skip pre-immigration planning? Could you tell us about it?
Frequent issues include penalties for non-disclosure of foreign accounts. That's primarily around failure to report foreign accounts under FBAR and FATCA, which definitely leads towards the penalties up to $10,000 per violation. Followed by that, there could be unexpected taxation on foreign income, which is around PFIC taxation, resulting in ordinary income treatment and interest charges. Next could be missed opportunity for basis step up, increasing future capital gains tax. And last but not the least, inadvertent creation of CFCs, triggering complex reporting on Form 5471. This failure to comply with these requirements can lead to significant cost and tax inefficiencies.
Thank you, Nikita. It takes me to the next question, which is the last. What practical steps should individuals take to get started?
First and foremost, engage a US CPA or tax advisor with cross-border expertise well before relocation. Followed by that, there should be a preparation of a comprehensive global asset inventory with valuations and cost basis. Next could be understanding reporting obligations, which is primarily around Form 8938, FBAR, Form 5471s, which are for CFCs, and Form 8621 for PFICs is important to understand. And last but not the least, consider timing of entry. Even a few weeks delay can materially impact tax liability and can lead to incurring additional costs.
Thank you, Nikita. That is a wrap on our discussion about pre-immigration planning. A big thank you to you for sharing your expertise. If you are planning on moving to the US, these insights can help you make informed decisions and avoid costly mistakes. Proactive planning can help you achieve tax efficiency and compliance. Stay tuned for more conversations on global tax and financial strategies. Until next time, thanks for listening.